Hey guys, we'll go ahead and get started. Sorry about that. Let's see. Okay, the first thing I wanted to go over, just welcome back from your week off. Everyone did great on the quiz or on the exam, so really proud of you guys. Did a great job. What did you guys think? Was it?
Yeah, it was.
It was fair.
I expected a lot of calculations.
Yeah, me too.
Yeah. I gave you a break on the first one. The second one is going to have some more calculations. I think it's around the long answer section. So we're going to be going over a lot of ratios and stuff in the second half. I want to talk about financial accounting, so that'll be coming up doing the calculations and stuff. The other thing, we were asked to let you guys know, make you aware. How many people know the College of Public Health offers scholarships just for our students? So we have some scholarships. The due date's March 1st, so and this is on your D2L, so you don't have to worry about writing anything down.
This is for undergraduates.
Some are from undergraduates, some graduate students qualify for as well. I think the Goodrow, you qualify for, and I was thinking, no, I think just the Goodrow one, graduate students qualify for, but all the information is on your D2L page, so if you want to apply, I strongly encourage you to apply, because the worst they can say is no, and then you move on to the next one, big deal. And if you get money, then yay, that's, $500,000 more in your pocket. But the application's right here. There's a link up to that, and then if you want some more information, you can sign up as well. But if you have any questions, just let me know, or let Janet Stork in the dean's office know. And we'll go ahead and get started today. So today in my clicker, the battery kind of fell out, so I'm going to have to be walking back and forth a lot, so I'm going to apologize in advance.
I'm going to plug this in so don't trip over my cord.
Dear goodness.
Okay. I warned it.
Just be up to date on your CPR and AED. First aid. Okay, so today we're going to be talking about, in Chapter 3, we're going to talk about income statement and changes in statement of equity. In Chapter 4, we're going to be talking about the balance sheet and the statement of cash flows. So what you have for Chapter 3, you should be looking at this one that says income statement at the top. Now, there's some fields that are not filled in yet, like total revenue, total expenses, I think net income, and maybe equity end of year. So we're going to fill that out as we go through the lecture today. And then when we get into 4, that's when we're going to use these other two, the balance sheet and the statement of cash flows. So just to let you know, that way we don't have to keep, flipping back and forth between slides and stuff like that. So again, won't go over the competencies. Agenda, just so you can kind of get your mind wrapped around some things that we're going to be talking about today. So you can see we talked before the exam a lot about managerial accounting. So we were looking at the subunit, more department level, how managers make decisions on how they staff or supplies needing and stuff. So this half, we're going to talk about financial accounting, kind of the reverse of that, and then go into, like I said, income statements, talking about revenues and expenses, and then financial condition analysis. So financial accounting is really just looking at, let me get all that out there. It's really just looking at how the organization is performing in an economic environment, or how financially sound it is to not your shareholders, well, shareholders if you're for profit, but stakeholders. But the difference between financial accounting and managerial accounting is financial, we're looking at an organizational level. Managerial, we were looking at the subunits. So we were looking at departments, or however they kind of have them compartmentalized. We're looking at subunits on managerial accounting, and then organizational overview for financial accounting. So we have a couple different financial sheets that we look at through financial accounting means. We look at income statement, which we're going to go over all these today, statement of changes of equity, balance sheet, and statement of cash flows. So we said, financial accounting is kind of that organizational overview of how they're doing. out in the environment currently financially, how viable they are. And so it's really driven by what we call like the outsiders' needs. But before we go on, who would you consider the outsiders to the organization? Like who would kind of drive the information that we're producing through these financial sheets? What's that? Like our customers, patients. If you're for profit, it would be your shareholders, right? Any of your stakeholders, regardless if you're for profit or nonprofit. It could be driven by community members, your board of directors. So anybody who, there was a question. So anybody, kind of outside the organization that has some kind of vested interest financially with how the organization is performing. I don't know why I kind of like did that individual pop-up thing, and I'm learning now it's really annoying. So, so it is important to managers when we look at managers in terms of investors, where managerial accounting helps them make decisions for their units. Financial accounting is going to help them from an investment standpoint. So we're going to look at financial position of the organization, but it's also a good kind of comparison benchmark to show us how we compare to organizations of similar size. So, Mountain States and Wellmont are kind of comparable in size, even though they're kind of going through a merger right now. Each still has their own financial accounting mechanisms, so their balance sheets are going to look different. Their income statements, things like that are going to look different. So it'll give us kind of that good data to look at to compare the two organizations financially and how they stand. So the overarching goal, or this really, the concept of financial accounting is just to give us some useful information so that we can go out as investors to make sound decisions. So it's really just we're just saying pretty much on 3 sheets of paper, here's all the information about our company from a financial standpoint. It's enough to go out and make some sound decisions if it's done correctly, right? So we know there's some organizations out there that's like a little less than truthful, and they kind of fix the books and mess with the financial sheets. But the purpose of the financial sheets is to help us make sound investment decisions.
The book said that HealthSouth did that, or fraud in their financial statements.
Yeah, so we've got there's a lot, you would think everybody would be truthful about it, but, let's be realistic. We know not everybody's going to conduct themselves that way for whatever reason. They have driving behind it, and I'm not defending them at all, but, there are some companies out there that's kind of less than truthful in their accounting practices for whatever reason, and whether you see that, I don't know whether you see that more on the for-profit side or the non-for-profit side, but, it does happen, unfortunately. So we're gonna take several little breaks as usual through this, but just want to ask you guys, we present these out mainly to give to our shareholders to kind of help them make sound investment decisions. But when we think in terms of nonprofit, do you think, one, that this information is still viable to nonprofit organizations because they don't have stakeholders, right? They are not beholden to stakeholders. They don't have to turn a profit to pay out dividends to their shareholders. So one, are these kind of financial statements still relevant to non-for-profits? And then two, even if they are, should they be held to the same regulations as those more for-profit organizations? What do you guys think?
I think it should be still be important, just in terms of the business itself, to make decisions as well, despite the fact that they don't have stakeholders or shareholders or whomever. But I think it still would be important for the organization itself to know where it's at, because at some point in time it's doing expenditures, it's spending out as well and whatever. So I still think they need to do it. I wouldn't hold them as high as the rest of
Yeah.
them.
So think about it. It's no different than making your budget out, right?
Right.
I mean, I have, obviously we went over my budget last time, but I have a budget, and you can think of these financial statements kind of like a budget for the organization in terms of I want to know what's coming in and out of my house financially so that I know I have like a real-time indicator on, man, I'm doing good, or, oh, buddy, I'm in trouble and I need to do something quick because my finances are in trouble. And it's not any different for for-profit or not-for-profit organizations. It's still going to give them kind of that internal look in, what's our income look like? What's our revenue? Are we turning the right revenues? What do our expenses look like? How do our assets look? How liquid are they? We want a lot of cash because that's most liquid and we can turn that over really quick in case, we have one of our lenders call up one of our loans and we have to pay that out really quick. So it's no different between for-profit and non-for-profit. And they are both held to kind of the same standards and regulations. But do you guys remember what those are called? We talked about them. I know it's been a while since we've been together, but remember what they were called? So we have,
That was the gap thing.
it was the GAP, yeah. Do you remember what it stands for?
General something. General accounting something.
Oh, so close. Generally accepted accounting principles.
That's close.
You were close. You got general and you got accounting in there, so I'll give you half credit on that.
Okay.
So when you think about kind of how our government is structured, we have one kind of regulation board over every kind of industry that we have. So who do you think would be the most appropriate kind of legal authority to regulate what we see in terms of financial statements and the content that we have on them? Who's going to regulate out that on our income statements we need to show net patient service revenue, premium revenue, salaries, benefits, supplies, things like that? Who's going to kind of set those standards?
I know the answer because I read the book.
Well, that's what I was hoping
Oh,
for.
okay. The SEC.
Yeah.
SEC.
So SEC, the Securities and Exchange Commission, that's what I was hoping for. See,
Okay.
you guys are in.
I was sure.
So the SEC does have a couple of ordinance. So it sets the standards and the regulations, and then it has a couple of organizations that it kind of relies on to make sure all this stuff that they're coming up with is implemented. And how you can think of this, teacher, this may not be a very good example for you, but for the rest of you it should be. So if you think, it's kind of like how the Joint Commission does the site visits for CMS, right? So we know CMS, kind of the accrediting, or not accrediting body, but Center for Medicare Medicaid Services, that kind of set the regulations for Medicare patients and, the care and their average length of stay and stuff. And the Joint Commission has deeming authority through CMS to kind of go out and make sure hospitals are following those regulations. It's the same thing here with the SEC, kind of the same dynamic. So you have the overall arching organization in the SEC, and then they have these kind of littler organizations that kind of go out and make sure, it's being implemented correctly. And if you're interested in healthcare finance and haven't joined the Healthcare Financial Management Association, I would highly recommend it. They put out a lot of good articles regarding things to do with healthcare finance. They have a lot of great stuff, and we post some every now and then on our department's Facebook page. So I'll put a little plug in there for that one. So GAAP, like Ashley said, the name of the guidelines that we kind of use to prepare these financial statements is called GAAP, and that's the Generally Accepted Accounting Principles. But how this is different than what we talked about last time with managerial accounting. Remember we said managerial accounting was used for only what? Kind of like internal, it's not going beyond the walls of the organization. So they don't have to conform to GAAP because every organization is going to do their managerial accounting differently. Some may use conventional-based budgeting, some may use zero-based. We may have a mix of some crazy different things going on. But for purposes of financial accounting, we do have to adhere to GAAP for that because the statements are created for external use. So these go out to if we think of our for-profit, these go out to their shareholders. If you have any investments, you should get, one of these on an annual or maybe a quarterly basis from whoever you're invested with to kind of see what's going on. And that's your right as a stakeholder or a shareholder to kind of call up the income statement and see what's going on for the organization. But the whole point is, you don't have to use GAAP when you're using statements just for internal use, but the statements we talk about through financial accounting do have to adhere to GAAP because they do kind of go outside beyond the walls of the organization. So within GAAP, if you're not familiar with it, we're going to kind of do a quick overview of it. We have three main categories that we're going to talk about. And there's 10 concepts total. So we have 4 assumptions, we have 4 principles, and we have 2 constraints, so things that kind of are like roadblocks for us. So the first couple assumptions that we talk about with GAAP is, the first kind of things that we automatically can go out and assume is we have a specific entity that the statements apply to. So these statements are specific to Sunnyvale Clinic. We assume that we're going to have indefinite life versus liquidated in the near future, meaning we're not anticipating this organization is going to go belly up next year. We're going to assume that it's going to continue on and on and on. That's just going to be our general assumption. Because, nobody wants to think, hey, my organization is going to go bankrupt next year, right? So we all want to assume that we're going to have some kind of indefinite lifetime. We don't know what that'll be, and we know from when we talked about sole proprietorships, corporations, partnerships, things like that. We know some have limited life, unlimited life, things like that. But we just automatically assume here through GAAP and through financial accounting mechanisms that we're going to have some kind of indefinite life attached to the organization. Periodicity, just assuming that we're looking at some certain amount of time. So if you look on your income statement right now, and those of you that are in the online section, these are posted on D2L on an Excel sheet just called Chapter 3 and 4. This should be the first tab on that Excel sheet. But when we talk about periodicity, we're talking about the income statement saying, what's the date for this income statement? What date are we looking at?
December 31st, or 2014 and 2015.
Yeah, so we're looking at specific years ended. So we have to say years ended December 31st because we're looking at a calendar year, right? And we know a lot of organizations, some will operate in a calendar year, meaning they go from January to December. Some will operate in a fiscal year where they go from July to June. So we're looking at year end December 31st for 2015 and 2014. So we get a little bit of historical data in there. So we have our defined time period and then our monetary units. So, in terms of when we talk about financial sheets here in the United States, we're going to talk in terms of dollars, right? Because that's our currency. If we go overseas or to a different country, their unit of measure is going to be different than what we're going to look at here when they do their financial sheets. So we have to have some kind of unit of measure definition. And here in the U.S., just as kind of an aside, these are all unadjusted for inflation or deflation or kind of what's going on in the economy at the time. So when we move from assumptions into principles, we have 4 different principles to look at under GAAP. Historical costs, we're looking at here what we bought X equipment for, or this piece of equipment for, at the time we bought it versus what it's worth now. Now, why would we do that? Why would we want to look at it from the amount we paid for it versus what it's worth now? Go ahead, you may know this, but we're going to get to it in a second. I just want to kind of testing you guys. So we know equipment does what over time? It depreciates, right? So we want to look at our assets in terms of historical costs and what they historically cost us at the time, because, let me see this on this one. Because if you look on your income statement, we account for depreciation there. So if we're looking at it in current fair market value, then not only are we devaluing how much the asset's worth to us, but we're also kind of double dipping because we account for it on depreciation as well. And then revenue recognition, we kind of talked about this with conventional zero-based budgeting a little. We touched on it. But with revenue recognition, when we talk about this principle, we need to recognize our revenues when they're received by the organization. So if I, have somebody come in for a service this month and it was $100, and then I send out the bill and they don't pay me till April, then I'm going to record that revenue received in April versus when the service was actually rendered. And so we have to consider this principle, the revenue recognition principle, when we talk about GAAP. The last two principles, expense matching, kind of related to kind of the reverse of revenue recognition, right? So we have to match our expenses to those related revenues so everything balances out, right? When we look at our balance sheet, if you took accounting in undergrad or if you're in some kind of accounting class now, the balance sheet has to do what? It has to balance, right? Your assets have to equal your liabilities plus your expenditures or your expenses. So expenses have to relate to the revenues so that everything balances out. And we have to give full disclosure. So we have to kind of give this complete picture of what's going on in the economy as it relates to our organization and some different economic events that are happening that may cause our financials to look, a little wonky sometimes. Sorry, I hate to keep walking back and forth in front of you guys, but I dropped my clicker and the battery flew off into outer space somewhere. So two constraints we said that there are with GAAP. Materiality, meaning that we are only going to record entries that are specific to us and specific to our operational and financial status, meaning we're only going to give you the important information. Maybe that less important information is going to stay back for our own internal decision making on our managerial accounting side, on those financial sheets that we create just for internal use. But we're only going to give you the important information as it relates to our organization as the stakeholder. And then the cost versus the benefits. So when we look at financial statements, let's take, our local example with Mountain States, their financial sheets, if they reported every single activity that they did on an external kind of financial sheet, how long would you think it would probably be like this big, right? Every little thing that they do. So we have to understand, and kind of the limiting factor here is that financial statements are not going to report all the information that we may think is relevant as the shareholder, or the stakeholder. I keep saying shareholder, I mean stakeholder. So the financial sheets are not going to report all that information. So when we consider this constraint, we know that even though we have these sheets, we may need to dive a little deeper into some different kinds of financial statements to get us a better picture of what's going on within the organization. And then, just the standard setters, those, the governing body organization, and those kind of key people within the organization are going to have to really determine if the benefits kind of outweigh the cost of doing all of this work. We're going too fast, right on track?
No.
Everybody's still good? So we'll get through this next little part and we'll take a quick little break. So here's where I'm going to test to see if you guys are ready again. So what kind of accounting recognizes an event when a cash transaction takes place? Cash accounting. Great job, guys. So cash accounting, just like it says, you're looking at, so think about my budget when you think about cash accounting. I'm looking at every penny that goes in and out, in and out, in and out. So it's really simple and easy. Thank goodness, because I try to make things as simple and easy on myself as possible. And it really is going to kind of mimic what your tax statements look like for cash accounting. So we're looking at events when the cash transaction, when there's an actual exchange of money taking place. So on the reverse side of that, what kind of accounting recognizes when an obligation is created? A cash obligation. What's that?
Accrual.
Accrual. Right, so accrual accounting A little bit more complicated, but the benefit here is it's going to give you a better picture of what's going on out in the economy. And if we're adhering to GAAP, this is required by GAAP, is to do the accrual accounting. So, for example, we have Sunnyvale Clinic, who we're using in our example today, and they provide services to their patients in December 2015. Ashley, no, looking ahead. I see you on. So they bill Blue Cross Blue Shield $700, but they're not going to get their payment until February 2016. So the services were rendered in December 2015. They don't get their payment till February 2016. So under cash accounting, when would we recognize this revenue? Under cash accounting.
February. When you're receiving the actual cash.
Right, because we receive the actual cash in February. Right. So what would be the case in accrual accounting? Would we do it in February or would we recognize it in December?
December.
Why is that?
Because accrual accounting, basically, the transaction is made.
Mm-hmm.
So
No, you're right.
the transaction, I'm familiar with it. I did it.
Yeah.
So the transaction is made. It's just that you don't have the actual money, but you have to put it on a statement, if you will, so you kind of know exactly what's going on. It's a credit. It's
Yeah,
one of the credits.
like a credit, yeah. And so remember, everything has to balance out and everything. It's one of those things that makes sense up here, then when you try to start getting out here, it gets a little convoluted. But yeah, just like I said, it's all about timing of when things occur, right? So when we give this service in December 2015 under accrual accounting, we have to account that we have this credit kind of out here waiting in maybe some type of accounts receivable line item to say, hey, we are still owed this $700. Don't forget that it's out here, and that just carries over until we receive that payment in. So what is a transaction? If you had to define a transaction when we're talking about accounting, how would you kind of go through and define that?
Paying for something.
Yeah, so what's a transaction when you go to the grocery
You're
store?
paying for something that you're receiving.
Right, they're giving you goods, you're giving them money. We've transacted, we've exchanged money for goods. So the exchange of goods and services from an individual to a business to another, right? We have some kind of exchange of goods in the market. So once a transaction is identified, it must be recorded, or what we call posted, to an account. So what is an account? So if we know what a transaction is, and we know the definition behind that and how that occurs, how would we define what the account is?
It's related to the business of all the ins and outs of the business, I guess.
Okay, related to the business, all the ins and outs. Do you have something, Teeter?
I can hear.
I know. Yeah. It's like, I know it up here. I just have to get it out here. Yeah, so an account, just that unique activity, how we're going to define it, is just that unique activity within a business. It's just an account. So we have the transaction, where we have that exchange of goods and services, and the account that it's posted to is just that unique line item. So think back, where's my marker? So think back to my budget, right? So I have income on my personal budget, right? And I have myself and how much I make. Remember I said I have my I just forgot the word I wanted to use, my expected. That's not the word I used, but I forgot it for a second. So I have how much I expect to get in, how much actually comes in, and what the variance is, right? And there's an R at the end of my name. I have my husband. Same thing for him too, right? So when I have, and then I have my expenses. And I may have like a category for my household expenses. And here I may have, my mortgage payment. What I expected, what it actually was, and what the variance is. So you can think of this as an account, right? That's a unique activity in my budget that there's going to be some kind of they're letting me live in my house, so I'm going to give them money, and that's our transaction in the exchange of goods and services. They're not coming and like repoing my house or anything because I'm paying them for that service. So each kind of little line item you can think of as an account, and you may hear it called that, just like a line item on the budget. Make sense? Cool. So how do you think managers, so then the question becomes, if you think, you know, my budget's fairly simple. I have my one house and I budget for everything. It still can get complicated. I was just talking to my husband this morning about how it just kind of stresses me out sometimes. So I have all the receipts and I got to put it in the budget and know what's going on. But if that kind of like small budget is enough to stress you out, or maybe I'm just a high stress person, but how do you think a large organization like a Mountain States, like a Wellmont, like a Mission Hospital or Tenova down in Knoxville, how do you think they manage with such a large account of numbers? You know, they're not going to have just like little bitty, you know, they're going to have lots and lots of accounts that they have to account for, right? Each department is probably going to have like a salaries, a benefits, a supplies, a miscellaneous, pharmaceuticals, on and on and on. So how do you think they kind of manage such a large account number of accounts?
And like a person, the departments that keep track and send it upwards, I don't know.
Yes, we have a whole department around financing, right? And we have people that come to school, they're trained in doing finance, they're trained in doing accounting and kind of how to manage this stuff. So they have a chart of accounts, which is kind of like my line item ledger, or if you think about a checkbook, right? If anybody still keeps a checkbook, my husband makes fun of me all the time because I still keep a checkbook. I still write things in the ledger to know what's going on. Yeah, you do too? Okay, yeah.
You're not alone.
He makes fun of me because he said, you can just get on your bank account and check. No, I can't, because if I have checks out there waiting, I need to know how much is exactly in my account. So think of a checkbook when you think of chart of accounts. So you have these line item ledgers that kind of assign numerical identifiers to individual accounts, meaning, you know, supplies, we may give that account number 99839. That's account 99839, and that's what we're going to charge this purchase to, is account 99839. Same thing here at ETSU. You know, I just went to a conference last week. We had to charge some stuff to the department, and when I went to fill out my travel claim, I put in the department's account number, and things are going to be charged to that particular chart of accounts for the university. Does that make sense? Did the checkbook thing kind of help bring it together? So we have journal data. So we collect all this data, bring it together, and this kind of journal data is going to help us create our financial statements. So we have our budgets, we have all the information, and we're compiling this data, you know, monthly as expenses are made, as revenue comes in, so we can kind of bring all this data together to make the financial sheets that we're going to talk about today, the income statement, the changes in equity, balance sheet, and statement of cash flows. But the primary means for kind of disseminating these financial statements is something called the annual report. Like I said earlier, if you have stocks in an organization, if you invest through a 401k or an IRA or something like that, you should get something called the annual report. And I just got mine for Northwestern Mutual. It's going to give you that ledger, that chart of accounts, like this is how much is in the account, this is how much you made throughout the year, this is how much the account overall made for the year. So you're going to get something called the annual report, and that's your right as a stakeholder or a shareholder for the organization, is to see this annual report along with their financial statements. So if you have stock in anything, you can call up the organization anytime and ask for their financial statements, so that you can look at your operating results, kind of anticipate things that are going to happen in the future in terms of, yeah, this has been a really good investment, or no, I need to get out now. You know, remember my simple example with my budget. It gives me a real-time view into doing really great, or oh buddy, I'm in trouble, I need to go out and get a second or third job or something, or make Stephen go get a fourth job. So we have the annual report, and then along with that comes the financial statements. Sorry, Steven's my husband, if nobody knows. But I keep referring to him. Let's go, before we start getting the financial statements, because I don't want to really stop once we get into this, let's go ahead and take you want to come back at 5, you want to come back at 5 till? Will that be a good long break? Because we got a little bit of time left started. So we're going to start back with income statements. And I think the next thing I have is a video, maybe. Yeah. So I got a short little video, if it'll come up and play, covering income statements. So I just use this as an intro to what we're about to talk about. So just sit back and relax and kind of take it all in. I might stop it and ask you a couple questions, but. Where have we seen a P&L statement before?
I've never
Right,
seen
so
one
we've
before.
already so we've already talked about income statements without you guys kind of knowing about it. Okay, so just kind of a little intro. Like it said, income statements go a little bit beyond Petal's little florist, where she apparently makes $500,000 a quarter. I wish, because then I would go into the flower business. But they're going to get a little more intricate, and that's why we have people that go to be trained to be CPAs. They do this stuff, or that's why we have CFOs for organizations, or that's why we have controllers or comptrollers that kind of manage all this stuff. But I just like to use that. I just like to use that as kind of like a little intro to what we're talking about today. So, when we think about financial status and the financial statements, these are the reports we give out to our outsiders, the people outside the organization. And so the most important question becomes, especially to anybody that's maybe a stakeholder or shareholder, is the business going to be making, or are we losing money? So think back to my budget, real time, I'm doing really great, or I need to get my finances in order because I'm doing something wrong. So we learned a lot about economic profitability, and then the income statement, like the video said, we can call it a P&L statement. Sometimes it's called a statement of operations, statement of activities, revenues and expenses. If you're in the non-for-profit world, you don't make revenues, you don't make profit, you make revenues over expenses, right? So sometimes you'll see it called a statement of revenues and expenses. But it's all the same thing. It's all an income statement. It's just, it goes by a couple different names for some reason because they didn't think it was confusing enough to start out with, I guess. So going back to what we learned before we went on the break, it goes over some period of time, whether that's a fiscal year, usually July to June, or an actual calendar year or CY, which would be January to December. So we have three elements, and you can kind of pull this up on your income statement. Let me get mine right here. So you can kind of pull this up on your income statement and kind of read along with it. But we have revenues, and when we're thinking in terms of the hospital or the healthcare environment, we're going to have a line item for patient revenues, and we're going to subtract from that our charity or our discount care because, discounted or charity care is not going to be factored into our revenues. And we're going to have other revenues, donations, grants, things like that, things that are more retail-ish, gift shop, cafeteria, things like that. And then when we think about revenues, we need to recognize that not all revenue is going to be realized or accounted for in this year. And why is that? We just talked about it before we went on break.
Because it's the cash.
Because it's the accrual accounting, right? So we're not going to recognize everything in this year. So the second part to the income statement is the expenses. So resource expenditures, how much are we spending? Think back to the video, how much did she spend to kind of produce the flowers to sell? So under accrual accounting, we're going to have cash and non-cash expenses recognized. So somebody remind me what depreciation is again?
Loss of value. Something.
Yeah, so if we have a piece of equipment that costs us $100, we know the life of the equipment is 5 years, then we know the depreciation value is going to be $20 a year until it just depreciates down to zero towards the end of life is what it's called. Then we have provision for bad debt. What is, somebody define provision for bad debt? What do you think? Or take a stab at it.
It's like something payment you make every year on some of your debts, service your debts.
Close. You're on the right track.
Money that you're not going to get back that people owe you, isn't it?
Right, so we go into a business hoping that everybody's going to pay their bills, right? But we're realists, and we know that not everybody's going to pay their bills. So we have this certain line item where we're going to account for that amount that we expect not to be paid back for. That's not discounted, and it's not charity care, it's just people didn't pay their bills for whatever reason. And so we account for that under provision for bad debts. And the profit measure or our profitability is going to be revenues. Obviously revenues minus expenses is going to tell us how profitable we are and how much is left after we account for our expenses. So if you pull up I just need to keep this in my hand so I don't have to keep going back and forth. Pull up your income statement. So we've come to the point in time we're going to talk about that now. So we have we have a column for 2015, a column for 2014, and I kind of broke it up into chunks. So we're going to look at operating revenues now. So we have net patient service revenue. Then we're going to take out the provision for bad debts, right? This is how much we're expecting not to be paid back out of this patient revenue. So that's going to give us a net patient revenue of $148. We're going to have premium revenues from our capitated patients. And then other revenues, so this may, our other services that are going to produce revenues. And we're going to come to a total service revenue of $169,979. Now, does everybody see how I got to $169,979? And for our online folks, you get to $148 by subtracting these two. And to $148, you add 18 and then $3,079. And that's going to give us our total revenue in 2015 and 2014. So you should, and I think that's not filled out on your sheet maybe, so if you want to write that down, 169,979 and 140,924 for our revenues. Good. Okay. So revenues, we're going to kind of take a little closer look into each different component. Revenues are going to come in a couple different formats. We're going to have a couple different categories or line items. Think back to the old budget. Patient service revenue, just what it kind of sounds like. This is all the revenue we're going to collect in from anything patient service related, including our fee for service and like we said, net patient service revenue is the net is going to be whatever we have for our service revenue minus our provision for bad debts. So, net after we get our fee for service revenue in, how much we're anticipating that we didn't get paid or that we're not going to get paid. Gross revenue is just going to be charge master prices. So just those overall prices associated with how much we're charging out and what we expect to be reimbursed on. And then our premium, revenue looked really weird. I didn't think I spelled it right to begin with. So premium revenue, again, is going to be those capitated patient revenues coming in. We're paid on per member per month, so we're going to consider that our premium revenue. And then our other revenue is related to, but it doesn't directly come from patient services. So this is going to be things like our more retail-ish, gift shops, cafeteria, even some hospitals, if you will give you parking fees or fines if you park in inappropriate places. And I'd say they get a lot from employees that want to park really close to the hospital so they don't have to walk far, because I saw that happen a lot. So they do give you, parking fees, things like that. But a couple of considerations for net patient service revenue. So we're going to have discounts and allowances. So any discounts we give through negotiation with insurers or third-party payments are not going to be reported as revenue because we're not getting that in as revenue. And then we're also not going to report charity care because we kind of just write that off at the end. So the question is, does revenue, based on what we just talked about, does revenue equal cash collected? Is revenue going to equal all of our cash? Why not?
Because it's not just the cash part, the debts and stuff.
Yeah. No. So some portion, if we think back to how we're doing accounting, some portion has not yet been collected. Remember, we've got that think back to our $700 example. Kind of hanging out there, hey, we haven't been paid yet, but we kind of got this credit out here that we still need to collect on. So the uncollected portion is going to come in the form of something called net patient accounts receivable. So that's if, think back to the bill that we sent out to Blue Cross Blue Shield for $700. That's going to end up in our net patient accounts receivable until it's paid, and then it moves out of that line item. So we're just waiting on that money to come in through receivables. And revenues, let's see. Yeah. So our next discussion question. What kind of impact do you think, based on what we know about capitation, and now kind of what we know about accounts receivable, and knowing that the uncollected portion of our revenues is going to show up in accounts receivable, how do you think capitation is going to affect accounts receivable? What kind of effect do you think one's going to have on the other?
At least you know that the amounts that you get every month.
Mm-hmm. What else do you guys think?
They're probably not going to match up because your capitation rate is the same, and whatever your
And why is it the same, the capitation rate?
paid per service per patient or whatever.
Per member per month, so we went out and negotiated the contract, and they say, hey, if you'll cover X amount of people, we'll give you X amount of dollars per person. So premium revenue is going to be reported at the start of each contract payment period, so really the start of every month, because we get that money in every month per member per month. So this is already setting us up to say, hey, we kind of like prepaid you to take care of these patients, so we have an obligation to provide these services now. And so when we provide the services, it's going to kind of throw us off a little because we're getting the money before the services come in. So moving from revenues into expenses, we're kind of in the middle part of your income statement. Yeah.
Before we get to expenses, is this final? Because we have the bad debts, for example, we have so many people owe us that might turn out to be quite bad debt, right? Like,
Yeah.
For example, the money we're not paid, we're supposed to be paid in February, for example, in your example.
Well, we anticipate so much every month or every quarter or every annual reporting period that people are just not going to pay us. And that's why we kind of look historically back at what our financial data is, because we can, give you with, good financial planners and people who are really, really good at doing, income statements and balance sheets, things like that, can probably give you, I don't know, would you say, Teeter, I know you're in, is it like within a 90% certainty how much we're not going to collect? And that's why, too, you can have your kind of little disclaimer note on your financial statement, different economic events that are going on at the time. So, we wouldn't want to necessarily go back all the way to pre-ACA when we saw a huge rise in uninsured. I'll get out in just a second. As opposed to now that everybody has insurance, because that would give us a really historical good look at what we can expect and what we can't, because we're looking at kind of like two different monumental times in our country's history in terms of finance and how people pay for things. So expenses, just what you can, kind of expect. So this is going to be things like your salaries, benefits, supplies, any leases that your organization has. So sometimes companies, instead of building a new kind of like brick and mortar place, they'll go out and lease because it's financially cheaper for them to do that. We'll have depreciation, interest, and then all these things together are going to amount to our total expenses. So, again, just some simple addition to kind of get us down to our expenses. And so you should have what it says here, 166, 232, and 136, 594 for total expenses. So we'll spend just a few minutes on expenses. So expenses are really just the cost of doing business. What did they call it in the video? The COGS, the cost of goods and services. And I just thought that word is like I really just wanted to say COGS is what it was. But the cost of doing business, cost of goods and services directly related to the business. Then we have our other line item expenses that are indirectly related to businesses. So how would we view expenses under accrual accounting? So how would we kind of look at expenses there? So expenses are not going to necessarily reflect the money we're paying out, right? Our cash outlays, because remember, it's all about timing. So under accrual expenses, when we look at our expenses, that's not necessarily the money we've paid out in cash outlays, just because of the way we time accrual accounting. So we have two categories of expenses, and this is kind of my test within the lecture. So two categories: natural classification, which classifies expenses by what? You better remember. So I have natural classification.
I saw the answer.
Thank you for being honest. So natural, just what you would think, nature of expense. Yeah, so natural nature of the expense. So we're going to have salary, supplies, research, blah, 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 so on and so on. And then we're going to have functional classification. So if we know what natural, what do you think functional is?
The purpose.
The purpose. So our expenses are going to be categorized by maybe all the expenses that are related to inpatient services, outpatient services, ambulatory care, however your organization is set up, you may classify them by function in terms of inpatient, outpatient, and so on. So what do you think the largest category of our expenses usually ends up being more often than not? When we think, especially from the health service organization standpoint.
It's definitely personnel.
Yeah, it's going to be our salaries and benefits, our labor costs, right? So, and just kind of as a bonus, who do you think we pay the most out to? Who comprises
Physicians.
Who comprises the largest portion of our health service organization? Maybe not the most salaries, but what kind of pool do we have that we owe the most money out to? Nurses,
Yeah.
because they make up the majority of our
Yeah.
healthcare organizations, right? They pretty much run the hospitals. So, salaries and benefits expense is going to account for that largest portion. So when we look at supply expense, so moving from salary and benefit, which is our first line item, we move into supply expense. And so we're looking at expendable materials. And the dollar amount doesn't always necessarily represent the amount we purchase, it's more the amount we consume. Because if you think about how we buy supplies, and if you have any experience in a larger organization, regardless if it's healthcare or not, you know, it's cheaper for us to buy in bulk, right? Because we can negotiate better discounts and things. So we're not necessarily looking at the amount we purchase, but how much of that bulk are we using and how much are we consuming, kind of like in a FIFO, LIFO setup. So supply stocks, they're going to be reported on our balance sheet as assets. Well, actually, yeah, more assets, but you can consider them liabilities too. It can kind of go either way. Another line item that we're going to look at in expenses is insurance. So, you know, we're all hopefully familiar with insurance. We have health insurance, we have car insurance. If you have a house, you have homeowners or renters insurance if you rent. So, you know, we have rent insurance for pretty much everything. But, you know, why do we buy insurance?
In the case of
Being injured.
disaster.
Yeah, like to guard myself against risk. I don't necessarily plan on going out and like falling and tripping and rolling down the stairs and breaking both my legs and having to go to the emergency room, but
It can
I have
happen.
it could happen. And knowing me, it probably is going to be, yeah,
Today,
it probably
but
will. It'll probably be
hopefully not.
today. But I buy insurance to protect myself against risk in case something happens. Or, you know, I don't plan on getting in a car wreck when I leave work to go home, but it could happen. And I have insurance to take care of me if it does. Nobody buys insurance planning on using it, but we kind of buy it to guard ourselves against risk. And organizations are the same way. So they're mainly concerned more with a lot of property risk or liability in terms of, you know, medical liability or managerial malfeasance. Does anybody know what malfeasance is? Malfeasance, managerial malfeasance. You know, if we have some managers that do the wrong thing, we can kind of protect ourselves. You know, it's all about self-preservation. We want to protect ourselves, and you know, just like Ashley brought up with the organization that maybe was doing some tricky accounting things for fraud. You know, we want to think everybody's going to be honest and hardworking coming into the organization, but again, we're realists and we know that's not going to be the case. So we buy insurance to kind of help protect against more of these liabilities in terms of medical. If, you know, something happens in the hospital, we have liability insurance to protect us if something, you know, God forbid, happens to the patient. We have liability to protect us against that. And then if we have, you know, managerial, supervisor, executive type levels that are a little less honest than what we would like in terms of malfeasance. And then property risk too, and, you know, fire, weather, flood, tornado, whatever may happen. Again, you know, I won't stay on this one too long, but organizations sometimes buy or lease property versus buying and kind of building these brick and mortar because it's more sound for them financially or a better decision for them financially. So just the cost of organizations' leases. So we may have some that are reported directly and others that are kind of put in the footnotes of your income statements. So, but, you know, why do we use lease instead of buy? Especially with equipment and stuff, we're really trying to protect ourselves against technological obsolescence. Didn't think I was going to get that one. But technological obsolescence, so, you know, we may lease an MRI machine versus buying it because, you know, if you've been in healthcare for 5 seconds, you know it's very fast-paced and changing. And it changes probably minute by minute. And so we know new things are always coming out, new innovations, things are turning over quickly, and the newest and greatest MRI machine today may be old news a month from now. But guess what? If we buy it, we're stuck with that machine, and that's probably a multi-million-dollar machine. So if we can go out and kind of negotiate a good lease, we may be able to work it in there that we'll get upgrades for free, right? Or we may, be able to pay so much to upgrade the machine. So we use leases not only to lease out property, but for our, technology and our machines that we use in the organization to kind of protect against them becoming obsolete. And, that has kind of a domino effect out into, our competition, right? We want to remain competitive. And if we're stuck with these old pieces of equipment, we can't really be as competitive as we need to draw patients and bring that revenue in. So depreciation expense, we've covered this. We'll just kind of highlight it again. So expenses got to be matched to the revenues that they're associated with. So in terms of depreciation, we kind of spread this cost of our asset out over many, many, many years, particularly around buildings and equipment. So we don't report it on the income statement at the time we acquire it, but like I said, we spread that cost out over many, many years. And then we amortize it, which we're going to talk about later on. We amortize it over the accounting life of the asset. So as far as today, that's all I want you to know about amortization. We have our most expensive items get listed approximate to the actual cash expenditures that we spend out on it. So when we have depreciation, expenses typically have no cash expenditure during that accounting period. Oops, sorry. Forgot to split that one into two slides. I thought there was more on there. And then into provision of bad debts, which I think you asked about, Ollie, maybe. So provision for bad debts, we have our net patient service revenue, and this is the portion of that net patient service revenue that we know with, if you have really good accounting personnel or financial personnel, can get you within 90 to 95% of, we know for sure we're not going to get this much in. And we base that on some historical data that we do, just kind of past experience. There's a lot that goes into it. We look at kind of like the demographics of the area that we're serving, what the income levels are, what's the economic indicators within this Tri-Cities region. Do we have a lot of unemployment? Do we have a boom in employment? What's kind of the financial situation looking at here? And just as a side note, this moved over to the revenue section in 2012. It used to be in the expense section. And then interest expense, if I'm sure some of you probably have college loans, but your interest is accruing on those loans even right now, even if you're not having to pay on them. But we have a line item for interest expense, and that's just the amount that we pay on any kind of debt that we finance. So, when we look at our operating income, that's the next line item under expenses. We should have $169,979 from our net operating revenue. We're going to subtract from that our total expenses, and that's going to give us our total operating income. So you should end up, if you do the calculations out, you should end up with 3,747 for 2015 and 4,330 for 2014. Give everybody a second to write that down while I grab some water.
Curious, I think they had it right in 2012. Shouldn't this be in the expenses, the bad debt?
You would think, and it was originally in the expenses, but
It's based on the expectation.
we said the SEC is kind of that governing board, and they came out and said we need to move this to the revenue section, right under net patient expenses, so that we can match them together. For what reason, I'm not entirely sure. But they did move it in 2012 into the income section. But I agree, I liked it better. I think it made more sense in the expense section. But
Maybe because you expect it to be a revenue when you spend it.
probably. but
And you
Yeah.
may,
They're
that's an
the
estimate, right? So that may not even be, that's probably why they did it, because you may not lose that much.
Might not be
Right.
fine along.
Yeah.
that'll be a good.
Who knows?
That would be if somebody wants to look that up. Ollie, if you want to look that up and bring in the answer at the next class, I'll give you 2 points on the next exam.
What? Cool. What?
That's what you get for asking good questions. So operating income, what is the most important element to you think, on the income statement? What do you think?
Let's pick one.
What do you think?
I think the net income,
The net income, why's that?
Because you go through all of that to find that that's like your real, that's your,
I agree
I don't
with
want
her.
to say your actual. Like that would be your actual
Mm-hmm.
Profit.
profit, if you will. That's
Yeah.
your money.
You're right. Profitability, right? We want to know how well we're doing. We want to know if we're sinking or swimming,
Because
right?
I mean, you go through all of that just to find.
Yeah. It's go through all that just to get this one number. It's so much work. So operating income, we're looking at economic profitability, and we're particularly focusing in on patient service activities that are kind of helping finance and bring in this level of revenue and this level of, in turn, level of income. So by measuring profitability, we're really looking at how are we performing at our core business functions. And so that's why we're, the most important element, if you're thinking in that term, is going to be profitability, because we're really looking at how's our core business functioning, because we're looking at patient service activities. If everything else were to fall away, the gift shop, the cafeteria, the more retail things, how are we going to survive just doing patient service activities? Or are we losing money here, but we're staying afloat because we have all these extra retail-y things out there?
Alright, to the previous one with the way they put the list, the provision for bad debt up there. And I know that accounting is probably different than the health accounting to an
Mhm.
extent. So just so I'm not confused, I'm
No,
not
that's fine.
confused because I'm doing both. Like usually in some instances they will have us before you actually get to the balance statement, they have us do the kind of like you get a trial balance and then you do an adjusted I think that's what they would call it, an adjustment. So basically, for instance, like with some insurance,
Mhm.
you would have a start out amount,
Mhm.
and then you adjust it where they kind of break down certain things. So then you subtract a certain amount or you add a certain amount before you get into balancing before you get to the balance sheet.
Oh, okay.
Yeah, the balance sheet
Yeah.
itself. So I mean, I guess my question is, do you think that would be what they do in the general accounting as opposed to moving it up to the revenue itself? Because it's the same thing. It's kind of like you would remove some to
Make
get an
the-
actual.
Yeah, making those adjustments to kind of get more towards that actual number. I would think so. I can't speak for certain, but we do have the director of finance for Mountain States coming in April, maybe.
The speaker.
Yeah,
for
the guest speaker.
breakfast?
Oh no, not breakfast with the expert. We have a guest speaker coming in for this
for
class.
Okay, cool.
So she's the director of finance for Mountain State, so that'd be a really good question for her. She would definitely be able to answer that question for you. Let me scroll back there. Let's see. Non-operating income. I think this is where we stop off. Yeah. So right under operating income, we're gonna have non-operating income, and this is gonna be our contributions and any income we make off of investments. So here you can see, just add them together, 4113. And then 3876 for 2014. Make sure that's on this sheet too. I'm kind of going along. Yeah, 4113. Okay. Kind of had to update this on the fly, so I'm a little paranoid that that I missed something. So non-operating income, just anything that's not related to provision for patient services. So contributions, more like donations that our organization can immediately go out and spend, or contributions that create endowments. These are not going to be reported on the income statement. And then you have investment income, so excess cash that's moved over into our reserves, and then endowments. Net income, so all we do here with net income, just take our operating, our non-operating, combine them together. That's going to give us our net income because we've already subtracted out accounted for our expenses in the operating income, right? So add those together, we're going to get 7860 for 20. Sorry, this should say 2015. This should say 2014. I told you I would miss something. 7860 for 2015 and 8206 for 2014. So when we look more into our net income, we're looking at our second measure of profitability here as opposed to our operating income. So this is really our bottom line. Let me go ahead and put all that out there. So measuring overall economic profitability, and in non-for-profit businesses, like I said at the beginning, it's either called, we can't say that we're making profit because that'd be kind of redundant, right? We're a non-for-profit organization. So we call it revenue over expenses. Where you would call it profit, we would call it revenue over expenses, excess revenue over expenses, or change in net assets. Just because, we're in a non-for-profit, we can't really say that we make a profit. We say that we have excess revenues over expenses. So the entire amount, because we are non-for-profit, we're kind of structured and set up just a little bit differently than more of your for-profit organizations that maybe pay out to shareholders. The entire amount of our excess revenue over expenses goes back to be reinvested into the business. So think about what we said the last time we were together. Everything we do pushes our mission, our vision, our values, right? So when we get our excess revenue over expenses in, we reinvest it back into the business, back into the community, to continue pushing our mission and our vision statement. So for profit, the net income belongs to the owners is really the major difference. So any income that's left over goes to the owners, which are the stakeholders, the shareholders, and those go out in the form of dividends. And then any remainder left over gets reinvested back into the business. So for-profits, and there are some for-profit healthcare organizations out there. There's some for-profit hospitals. So they have a little bit of, they all have mission, vision, and values, right? But for-profit has a little bit different drive in why they do the things they do, because now they're beholden to some stakeholders that they have to pay out dividends to. So they have a real push to start creating a lot of this this revenue and this income, because not only do they have to pay out dividends, but they have to make enough to reinvest into the business after those dividends are paid out to continue operations. So net income versus cash flow. Does income necessarily represent cash flow? In accrual accounting, just remember back to the way it works, net income does not represent cash flow. Because on the income statement data, cash flow, or you'll see it called CF, can be approximated by your net income plus your non-cash expenses, which is your net income plus your depreciation. So in terms of this worksheet, and this may be my greatest fear coming true, or I've missed something, your net income, let's see. Oh, no, I didn't. Great. Your net income, 7.86 plus 6.405 is going to give you a cash flow of 14.265. So just take your net income plus your non-cash expenses, which is your net income plus your depreciation. Everyone still with me?
Where'd you get that from the sheet?
So net income.
This one?
Net income 7.8. This one's just broken out into millions,
Okay.
and that one's not. So 7.8. So on the sheet, it's going to say 7,860 total. Net income. plus your depreciation, which go back up under expenses. Depreciation, the line item 6,405.
I see cash.
Yep, as the cash flow.
Thank you.
Awesome. So income statements for investor-owned and non-for-profit, we're gonna just briefly go over them so that you can at least be familiar with them. Remember, I said the whole point of this class is kind of give you that foundation into accounting and finance, and we can talk later if you want to know more about healthcare accounting and finance. But the income statements between the two types of setups are very, very similar. Revenue and costs in the organization kind of go on the same line item and are very similar regardless of ownership. But there may be some transactions that are applicable only to for-profit businesses, so we may only see them on the for-profit income statement side, and that's things like income tax payments. Because since they're for-profit, they still do have to pay taxes on their businesses. Changes in statement of equity. So now we're at the very bottom of our income statement sheet. So we should have our net income, 7860 for 2015, 8206 for 2014. Equity at the beginning of the year. Let's see if it's there. So 2014, we ended the year with $46,208. Right, so we get our net income from this year. We bring over our equity, so this would have been from 2013. We would have brought over our equity at the end of the year from 2013 into 2014. To see what we did here, we took our equity at the end of the year and brought it over. We start the year out with the same equity that we ended with, right? Because we're looking at December 31st of 2014 and 2015. So you take your net income, you add to that the equity that you had at the beginning of the year, and hopefully that'll come out to be a positive. But you always kind of just, everybody sees how I could just carried it over to start your equity for the next year. And so when we set up 2016, what's our equity at the beginning of the year going to be?
5468.
Yeah, $54,068 when we start 2016. So statement and changes of equity or changes in net assets. So how much of the organization's net income that we make throughout the year is going to be retained in the business in terms of assets? So how much are we going to have to kind of reinvest back into the business for operations or to continue on our mission, vision, value statements? And here we reconcile what the income statement, the net income is, with the balance sheet equity account. And that's why they're both on the same sheet here. And so you just reconcile the two. For a non-for-profit, though, the amount of net income, the entire amount's going to flow into the balance sheet. And there's going to be a couple deductions to reduce that amount, just for different payouts that we have to make. Sorry, I flipped through too quick. But there are going to be some of your more typical deductions to the net income that kind of reduce that amount that flows over into the balance sheet, which we're going to talk about next, and you should have your balance sheet already. So all three are kind of interconnected, and you need information off of each one to kind of complete the other. So financial condition analysis, I think this is where we're going to end with this one for this particular lecture. We'll take a quick break, and then we'll come back and start with chapter 4. But financial condition analysis, so this is our first kind of intro into a couple of different ratios that we're going to be doing. Within the next couple lectures, we're going to have a lot of more ratios that we're going to have to calculate. So on your next exam, you can kind of already anticipate that you're going to have a lot more calculations to go through in terms of how we calculate ratios, and not only how we calculate them, but how are we analyzing them, and what is 4.6% really telling me? So we have a total profit margin. So, for example, our total profit margin ratio that we're going to look at to tell us, just how we're doing financially. How many dollars of revenue are requiring how many cents in expenses. We're going to look at total margin equaling net income. So we're going to take $7,860, and we're going to divide that by our total revenue, which we had at $1,600. 169,979. So when we divide that out, we're gonna get 4.6%. So that's great. You can do basic. You can do basic math, but what does that really tell you? What is 4.6 really telling you? So how do we interpret this ratio, and how we need to look at this is for each dollar of revenue that we're putting out, how many cents did we get back? We got back about 5 cents. So if you go a little bit beyond that, how much money did we have to put out in expenses to get 5 cents of revenue? If we know for every dollar of revenue that we're bringing in, so we get $1 revenue in, we're getting $1, right? So for every dollar we get in, we get to so we got to keep 5 cents of that, right? How much do we have to pay out to get that 5 cents in? Right, because 95 and 5 make $1, right? So for every dollar that we're getting in, we had to put 95 cents out to bring that dollar in. Make sense?
Mhm.
So, like I said, we're going to go over a lot more ratios. This is just kind of your first intro into the world of ratios. So before we kind of go on our second break for the day, just a quick, like we always do, what are a couple things you guys picked up on through today that you may see, that you may anticipate you'd see on future exams? We kind of did this self-building study guide. I don't know if that helped anybody last time, but I think it's good to just kind of get you guys talking, see what you learned today. So what did you kind of pick up on today?
The differences of financial accounting.
Okay, financial accounting versus managerial accounting. Is that what you're saying?
Yeah. And then the cash and accrual accounting.
Okay, cash versus accrual. Okay.
The gap assumptions,
Oh, that's
principles.
Call that 4 by 4 by 2. Seems like forever ago we talked about those, and I was just today. Okay, what else?
Revenue classification.
Revenue classifications. Okay, so how do we classify revenues? REVENU.
Functional.
Revenues, expenses, right? How do we operating income, non-operating income,
Net income.
net, okay, our equities, and how we carry over ending equity from one year into the next year, because that's what we're going to start out with. Maybe that total I just said total margin. Total margin ratio. Okay.
Income statement.
Yeah, just how to read the income statement. What is it telling you exactly? So reading the income statement. Okay, good list, guys. Okay, so what I'm going to do, I'm going to go ahead and stop the video here for our online people so you don't think you just randomly got cut off. We're going to come back in. You want to come back again at 10 till? I'll give us about 5 minutes. Okay, 10 till.